Hello and good morning, everyone. Welcome back to Almus Market Mornings with your host Shikhar Garg. Now I know we have had some bit of a good weekend, but hopefully you guys are prepared for an eventful week ahead because we have FOMC and geopolitics still coming on. So going straight ahead into our updates, JK, we'd like to know what are the things that happened over the weekend and what should we look for in the markets coming ahead.
Hi, good morning. For those of us who were looking for some good news over the weekend, it was quite discouraging and disappointing. Actually, there were unnerving news. Russia threatened to attack Western shipments of weapons to Ukraine. They also airstruck International Peacekeeping Security Center in the Uvoriv district, which is about 25 kilometers from the border of Poland. This raised the alarms that the Russians were expanding their attacks and could elicit more reactions from the West. According to Macron, a French president, Russian Putin does not show a willingness to end war during a call with the French and German leaders. Western countries, on their part, removed Russia from the most favored nation on the trade front, took measures to make it difficult for Russia to use crypto assets to circumvent sanctions, and banned more items of import, apart from stopping investments, technology transfers, financial services for energy exploration and production, all of which will have a further adverse effect on the Russian economy. Another bad news was China locking down one of its large regions due to spread of virus. On the economic data front, US consumer sentiment worsened, and this in the backdrop of heightening inflation is not good news. The worst case scenario of slower growth and higher inflation rates is more likely, keeping the investors at bay. Despite this, US 10-year yield saw a massive volatility last week. US 10-year yield moved up 35 basis points higher than the low of 1.66 seen during last week. CFTC saw there is maximum short positions in 10-year futures in the last 2 years. These moves are happening as we are within 2 days of the crucial FOMC meet. In other data, Canadian employment was very strong, beating market expectations, while UK GDP also surprised to the upside. On Indian side, there are some indications of things not worsening from the war front. If you look at the safe havens, like gold, yen, Chinese yuan have all fallen, while the European currencies are weaker on stagflation fears again and prolonged impact due to their huge investments in Russia. Chinese yuan, which has been recently treated as a safe haven, has eased quite a bit in the last 2 sessions on reports of possible easing measures. Analysts are also looking at Premier Lee's cautious tone against the weak GDP expected. As for India, the IIP recovered to 1.3% in January after hitting 10-month low in December, with manufacturing sector growing at 1.1% versus minus 0.9% previous month. Of course, the positive numbers were boosted by base effect, while private capex continues to contract. India's inflation data are due out later today, with WPI at 12 noon and CPI later at 5:30 p.m. Both are expected to use somewhat, but they will be getting support from a higher base effect. Sorry. The 10-year bond yield closed at 6.86% on Friday, and the fixed income market would be taking cues from the forthcoming inflation data. We also had some good news. S&P Global Rating Agency said India's sovereign rating was not under threat due to current weakness in the rupee. Despite the possibility of worsening current account deficit, India's low foreign currency debt made it secure on the ratings front. They also sounded optimistic on India's growth prospects, as it is actually experiencing a pretty sound and healthy recovery coming out of the pandemic. S&P expects India's GDP to grow at 9.5% in FY22 and by an above 7.8% in FY23, putting it among the fastest growth rates for emerging markets, and important to keep in context with regard to India's credit story. Oil holding lower levels is some support for the rupee, while expectation of higher rates in US is negative. Expect rupee to be on the defensive on account of war factor and FOMC. However, we are seeing flows on both sides, inflows due to seasonal factors and outflows from importers looking to hedge more. Range between 76 and 77 should be safe for now, with the RBI actively managing the volatility within the said band. However, this is a week of a lot of economic data, including FOMC and POJ meeting as well. So it's going to be a volatile week again, with an eye constantly on the war front. Thank you.
Okay, all right, JK, that was quite good. And yes, we are having our CPI data releasing today. So we can expect some bit of volatility on the currency front as well from that point, as JK mentioned. Let's brace ourselves. That's it for today's commentary, though. We do have an announcement for you guys, since the markets are being so volatile, and Almus Market Mornings covers the regular bit of updates. We will continue to share our broader themes on the market and our views on broader themes of the market, and we'll be releasing a video on that soon. So guys, watch out for theme based or a longer term update from our side. That's it for today. Till then, goodbye.